What I want to talk about today is starting too big with a whole life insurance policy. What I mean when I say starting too big is taking out a policy where we plan to pay in a large amount of money. Let's say your plan is to pay in $100,000 per year. You think you can do that realistically, but then you only end up funding $70,000 or $50,000 per year. Meaning we bite off more than we can chew. Perhaps we're overly excited. We look at our financials and we think, oh man, I can really overfund this policy. I love all the benefits when I look at the cash value. And then you get into it, reality hits, I think I went a bit too big. If I could do things all over again, I would have only went with a policy with a $70,000 maximum instead of a $100,000 maximum. Does that make sense? This is an important point to talk about because what can really result in buyer's remorse or disappointment when it comes to these products is taking out a policy and not max funding it. If I take out a whole life insurance policy and I max fund it year in and year out, meaning I pay 10x my base premium, I fund up to the MEC limit, those numbers will look good, both on a guaranteed and a non-guaranteed basis. But if I don't do that, or if I have a high base premium relative to my total payment every year, that's where the cash value is going to grow slower, and often where people look at it and say, I think I could do much better elsewhere. I'm just not satisfied with this product. So we're going to look at a case study that demonstrates exactly that. This is based on someone I recently spoke with to provide some details. He is at the stage where he's just about ready to start a policy, but would like a little bit of guidance. He had looked at models with a different agency, but had some questions specifically around this. He had been shown different illustrations that display if you max fund this thing and pay a lot of money in for a long time, it looks great. But his question, or I should say his objection was, okay, those illustrations look fantastic, but what if I can't get this dollar amount in? How much does it negatively impact me? That's what I'm interested in. So some details here. Age 40. Company, as far as the insurance company he wants to select, he's unsure. He did mention that he wants flexibility. So we prepared options with Mass Mutual and Guardian. Today's video, we're just going to look at Guardian samples. It's going to be a very, very simple illustration to demonstrate the main point, but flexibility is important to him, meaning he wants the ability to commit to a small amount so the product does not feel like a burden, and then add additional funds at discretion. With the funding, he's interested in a dollar amount anywhere between $100,000 and $300,000 per year. That's a large amount of money. And the number of years that we're going to look at funding a policy, anywhere from 5 to 25 years. Today, we're just going to look at 5 years. In our next video, we'll look at a different version that he wanted to see with funding a policy for a long period of time. And he does have an interest in using the cash value as the years pass. So to hit on that point that we mentioned earlier, what if I go too big? I start with a policy that's more than I can handle, or I was overexcited. I thought I could get a ton of money in and I'm like, man, I couldn't do it. Now what do I do? So to summarize that, what that means when looking at an illustration, if we start with the good looking illustration, meaning a max funded policy. So if I max fund, the numbers look great. What max fund means is if he goes with the $300,000 per year option, so if he wants to fund $300K per year for 5 years, which is 1.5 million, if he does that and actually pays in $300K per year for 5 years, that illustration will look beautiful. We're going to pull it up in a minute, the 3 different versions we're going to look at, but it'll look fantastic. The question is this: what does it look like if I fund less? Meaning if I go with the $300K option, because I think I can do that, but I only get $200K in or $100K in, how much does it hurt me? And how do you illustrate that so I can actually visualize it? Because we can talk about it all day long, but if I could see the numbers, that will help oh so much. We're going to look at the numbers. So here's exactly what we will look at. We're going to look at funding a policy for 5 years. Simple starting point. We'll look at a longer funding scenario in our next video. But 3 different options here that he wanted to see. What does it look like if I pay $100K per year? $200K? And then he mentioned, I could even do $300K. Like, there's years I'll be able to handle that no problem. So if I do that for 5 years, what does that give me? I get a total of 500K in. With this, I get a total of 1 million in. And with this, I get a total of $1.5 million in. What do you notice on the bottom there? 3A. What's that? Funding 200K, but with the 300K option. So what this would mean, or what this means, is he selects option 3, where he plans on paying $300,000 per year, but he only gets in $200,000 per year. That would result in him saying, if I could go back in time, I would have started with option 2. We're going to look at exactly that. What we'll look at first is 1, 2, and 3. Those dollar amounts going in for 5 years. We're going to hit on the design of the policy. And this will demonstrate quite nicely, regardless of the dollar amount you're looking at, if all things are designed equally, you'll see very, very similar cash values, similar break-even points. Everything will look like what it's supposed to look like, and we don't have to pay in 3 times the amount to get the results of paying in what we see in option 1, if that made sense. All right, so let's take a look. What we've got here, 100K per year for 5 years. I like this report in the illustration because we see both the guaranteed values right here, and then we see non-guaranteed current. This represents the present dividend interest rate, and this represents no dividends, only the guaranteed rate, which is 3% with this product. So these two are a great starting point. Intermediate represents a dividend rate in between the current dividend rate, which is 5.75%, and the guaranteed rate of 3%, which would come out to, what would that be, 4.25%. But we won't look at that today. We'll just look at these two. So looking at those values, what do you notice here? Year 1, 100K goes in. You've got 88% right out of the gates. When's your break-even point? Isolating again the guaranteed values. Just about year 6. Because you paid in 500, you paid nothing thereafter, so in year 6 you don't pay anything in, and you've got 498, 821, so close to 500, and then year 7, there's your break-even point. And he can keep paying the premium here, by the way, if he wants to, but we're looking to stop after 5 years. The example to the right, what do you notice? Based on the present dividend rate, the non-guaranteed values, the break-even point is between years 3 and 4. And we've seen this. I've seen this happen, particularly with Guardian products, with this type of design. This has the 5% PUA fee, which they've had for a long time. We've seen this to occur on a very, very consistent basis with actual policies, not illustrations, which is always nice to see. But there I see the break-even between 3 and 4. Guarantees just about year 6. The last thing that I would note would be this. There's your premium. There's your PUA. Notice that the PUA is literally 10x what the base premium is on this illustration. PUA does first support the term cost, and then everything else goes into PUAs. But you see that 10x ratio and 88% cash value in the first year. Have that in mind? All right. Next example, 200K. Look at this. PUA on the illustration is 10x the base premium. When's your break-even point? Look at the guarantees. So close to year 6. Year 7, you're positive, based on the non-guarantees. Between years 3 and 4. By year 3, you've paid in $200,000 per year. Times 3 years is $600,000. You're at $592. By year 4, $800,000 paid in. There's the cash value. Very, very similar. You'll see very comparable internal rates of return if we look at an IRR report. And then here we go. Same thing, the 300K option. Notice the death benefits increasing to accommodate the MEC limit. But look at that, just about there, year 6. Year 7, you are positive. Over here, between 3 and 4. And then this guy. This would be 3A. Where you'll notice, if we go back to 3, there's your base premium, there's your death benefit. 3A, base premium, death benefit. What's different? The funding is $200,000. Whereas when we go back to the last, it's $300K. As a result, look at the guaranteed break-even point. Between 8 and 9. the non-guaranteed break-even point between 4 and 5. What happens if we create another what-if scenario? Some individuals like to see these. What if we only paid in 100 or 150? So let's compare and contrast here, shall we? So what we've got first is exactly what we looked at, but just a simplified version. And this displays just the current dividend rate, so the non-guaranteed values. What I like about this, between years 3 and 4, you see what's highlighted in yellow, which is your break-even point, because the design is identical on each of these policies. Minimum death benefit to prevent a MEC, and the base premium is at 10%, a little bit less when we combine the base premium and the term insurance rider. So there we go. These are the max funded examples. But what we want to look at is the next tab, 300K versus 200K. Let's take a look here. So what we've got first, there's your $300,000 per year for 5 years. And we've got an extra column in here just to help simplify things a bit. If I'm sitting on your side of the table and we're speaking with an insurance agent, this is the kind of stuff I'm going to be asking for or looking for in the illustration and making sure everything's set up properly. Here's the minimum premium, $30,000. And that minimum premium, by the way, is combining that base premium. Remember what that dollar figure was? On the illustration, it was $27,000 and change. And then also the term rider, and then I rounded up a bit for simplicity. But a minimum of, call it $30,000, but the annual funding we saw in the illustration is $300,000. 300K MEC limit, main thing to look at here. Minimum 30, death benefit 6.1, MEC limit 300, and there's your funding. Have that in mind? All right. Next option, same policy. This would be 3A, exact same policy, but less funding. So what we've got here, same 30K as far as the minimum, same 300K MEC limit, same death benefit, which is what gave us the MEC limit there. But what's different? The annual funding, $200K per year. Cash value, I'm only paying in $200,000, where I could pay up to 3. But what happens from a break-even standpoint? Very close to year 4, but it's technically between years 4 and 5 when I look at this. Now, I can continue to add money if I wanted to add $200K for another 2 years and then $100K to get the same $1.5 million in. I can do that, so I can keep funding it, or maybe I throw in another $500 here, make up for lost time. You can do that kind of stuff as well. But again, what we want to show is what if he goes with this option, only pays in $200,000, and then says if I could go back in time, I would have went with this option. Because what do you have here? Your annual funding, look at this, is identical. Remember when I first got into the industry, not when I first got in, but when I was working with someone at a firm, this was many years ago, we were talking about policy design, and he said, you know, if you've got the same product and the client's paying the same dollar amount in and you just design it differently, in the client's eyes, it's the same money out of pocket. It doesn't really matter if it's going toward premium or PUA. It does matter where it's going in order to maximize cash value, but how they're going to view it in many cases is here's the dollar amount they are writing a check for and sending it to the insurance company. So the design's very important here because from the client's perspective, what they'll see is, in this option, I pay in $200K per year. Same thing with this one, but I've got more value over here. What's going on? What's going on is this. Look at your minimum premium here, $20,000. Over here, $30,000. Death benefit, just over $4 million, which gives you a MEC limit of $200,000, which means that is the maximum dollar amount, $200,000 per year, that you can add to this policy. Where he would not go with this option if he said, that's not enough. Like, I've got some bonuses during some years that are more than that, and I want to be able to throw them into the policy. So if that's the case, that's where he may go with the higher end option, but he wanted to see the comparison. He asked this question in a different way many times. So this is meant to help here. So if we look at this, break even is now between years 3 and 4, but let's take a look. Here's really what we want to look at, cash value difference. So this displays, very simply, 200K per year going in, both options, you get the same 1 million in over 5 years. In the first year, as a result of having a premium that is about $10,000 less, when we compare the two, what's the cash value difference? Almost $10,000. As we look at it over time, what happens? I see the option with the lower base premium and $200,000 MEC limit have more money. Now, what I like to look at here, this is personally how I like to view it when I'm making a decision here, is what's the difference in cash value? Let's look at year 10 and also year 20. And we can go further down. He paid in $1 million. You've got about a $27,000 difference and then almost a $36,000 difference. If you look at year 20, 36K, when you paid in a total of $1 million, when you look at that number right there, do you look at that and say, no, like I want to have that? Going with the higher end option, I don't think that I'm going to be able to get more than 200K into it, and the 35,000 and change just kind of rubs me the wrong way. I want to make sure I've got that in value, or I want to get as much as I can. Then I would go with this option. However, if you look at that and say, you know, it's a $35,000 difference over 20 years. It's a long time. But then second, 200K, I know I can do that. But I think that I will be able to get more than 200K into the policy during some years. Some years it might be 300. I might even be able to do them during all years, but I definitely want that option open to add more than 200K. Well, if he does that, if he goes with the higher end option and he's able to overfund it, meaning get more than 200K into this one, then we'll be in a situation where he will have more cash value and the flexibility to add more funds. And a question that comes up sometimes is, well, can I just take the 200K option and open a new policy? Can absolutely do that. Where people sometimes dislike that strategy is what happens when you open a new policy. You can see it up on the board. Any of the examples, you make a payment, even if it's designed for maximum cash value, do you have more or less in cash value than what you paid in? The first year you have less. If you have a policy that's been in force for 4 or 5 years or longer, and you add money to it, what's your cash value look like the next year? Is it more or less than what you paid in? So if you paid 100 grand, do you get that 100K back and some, or do you take a hit like you do in the first year? You get more back, it's better. So my point is, if we have the ability to add more to it, that can sometimes benefit us, or it will benefit us in that situation. So sometimes people do like to consider that as well in order to prevent going through the early expenses. And again, that might be a fit for you if you look at the numbers and feel fairly confident that you can add more than whatever that maximum is during a couple of years of the policy, or potentially every year. So I hope you enjoyed this video. If you did, please let us know. Please hit the like button. Leave any questions or comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.